Good morning.
Good morning. Yeah, we're gonna give her a couple more. It takes a couple seconds for it to catch up with everybody here. So I'm watching the numbers.
Okay, just cue me.
Yep, absolutely. So it's spinning up now for everybody. All right, good morning and welcome to another one of our Coping with COVID-19 Creative Solutions for Your Business webinar series webinars. My name is Patrick Lensman, Senior Program Manager at the Center for Business Growth and Innovation at the University of Northern Iowa. We appreciate you taking the time this morning to come and watch and join with us. This is an interactive webinar. We're going to be live for about 30 minutes. So if you do have questions around this topic, please do feel free to put them in the Q&A box or to comment if you're watching us live on Facebook. And we'll make sure we can do our best to either answer those or direct you to the right resource that will be able to answer your questions. Our topic this morning, which is one that's been talked about a lot and is definitely important to continue to talk about, is the CARES Act, one of the big pieces of legislation that was passed in the last couple of weeks. Joining me this morning is Kristan from EideBailly, and we're going to be talking about the CARES Act tax provisions. Joe, we appreciate you taking the time to speak with us this morning and appreciate any insights you can provide.
Well, thank you. Before we get fully into the CARES tax provisions, we're going to talk a little bit about what the deadlines are. Of course, April 15th is the traditional tax return deadline, and the federal government has deferred all April 15th due dates to July 15th, including first quarter federal estimates. Oddly, they have not deferred the second quarter federal estimates. Iowa has deferred all the April 30th usual due dates to July 30th, but they have not deferred estimated tax payment dates. So that's something that we need to keep an eye on, and possibly a solution for that will be to overpay any balances due in April and then apply that to estimated taxes as needed. Iowa is also expected to come out with new guidance, possibly as soon as today, if not certainly within the next few days, on some safe harbors for first quarter estimated tax payments for people who aren't going to file their Iowa taxes until July. So with that sort of setting the stage, let's talk a little bit about some of the provisions of the CARES Act. Probably the biggest things that people have thought about are the provisions relating to the SBA Forgivable Loans and the Employee Retention Credit. And we'll touch on those briefly, but mostly I want to talk about some other provisions that may set a number of people in line to claim refunds for prior years without having to deal with SBA loans and without having to deal with tax credits. So with that, we'll get started here. First thing we're going to talk about is the new Employee Retention Credit. This is available to employers whose operations are fully or partially suspended due to a shutdown order, or who have had gross receipts declines of more than 50% compared with the same quarter in the prior year. The amount of the credit is 50% of the first $10,000 of wages and related health care costs for employees who are not working as a result, who have nothing to do as a result of reduced operations, and are limited to wages paid or incurred from March 13th through the end of the year. And you cannot count wages for which a refund was claimed under the Family First Act, which was the first wave of relief passed by Congress. You also cannot claim that and claim an SBA forgivable loan. These are generally available for employers with fewer than 500 employees, though in a number of cases you can go above that. The maximum loan is the lesser of 2.5 times average monthly payroll, or 10 million. The borrowed funds have to be used for payroll, continuation of healthcare benefits, interest on mortgage and pre-existing debt, and rent and utilities. Basically things to keep people on the payroll and keep the doors open. The maximum interest rate on that is 4%. The loans are 100% guaranteed, and the loans are eligible for forgiveness based on how much of your payroll you keep intact. So those are obviously very popular by those provisions. However, the banks have been overwhelmed by requests for these loans. There's still a lot of guidance coming out. The banks really don't fully know what they have to do. Borrowers don't fully know what information they have. Just this week, the Treasury issued a 20 question and answer frequently asked questions guidance. That helps a lot, but there are still some key questions out there that relate especially to how partnerships and LLCs, taxes partnerships, are treated under these provisions. And so there's still going to be more guidance coming out on that. If you shoot an email or ask for it, I can send you links to a lot of the information that's out there, a lot of good guidance on how to go about getting these loans. I could spend probably the whole half hour talking about what we don't know about these loans. So I'm not going to talk a lot more about that right now. But I will be happy to send you a lot of additional information on those. Now we'll go directly into some other things that, while less sexy than forgivable loans, are probably going to be very practical to a lot of people and aren't necessarily getting talked about. One is a provision that is going to allow people to tap IRAs and 401ks for up to $100,000 without an early distribution penalty for a coronavirus need. There will be no income if they're repaid within 3 years. If you're taking out as a distribution rather than a loan, you can spread the income tax impact out over 3 years. And you have to meet certain conditions. Basically, you have to be diagnosed, you have to have a spouse or dependent diagnosed, or you have to have adverse financial consequences due to reduced work or childcare. There are liberalized plan loan rules as to how much you can take out, the lesser of $100,000 or the account balance, and you can delay loan repayments. IRS is waiving the minimum required distribution rules for a year. So if you're 70 and a half, you can hold off on taking money out of a plan. If you have a single employer defined benefit plan, you can delay your contributions, and you can use your 2019 funding targets for defined benefit plans. Then there's a new set of rules for charitable contributions. One which is fairly minor. You'll get a $300 additional above the line charitable deduction for 2020 without regard to itemization. You can sort of think of this cynically as an additional $300 standard deduction. Also, the limitation for itemized deductions for individuals is suspended for 2020. So that's to encourage people to make more charitable gifts in 2020, presumably for CARES Act issues. Okay, now let's talk about some of the better self-help provisions that are out there in the CARES Act. One of the most important is temporary modification of the net operating loss rules. In the 2017 tax law, the feds did away with carrybacks of net operating losses. They only allowed them to be carried forward. That's very harsh in a recession because that means you may have lost money in year one and year two, income in year one, big loss in year two. But under the 2017 law changes, you couldn't go back and recover that loss. You had to wait until you had future income in order to get a tax benefit for your current year losses. CARES Act changes that for 2018, 2019, and 2020 losses. For losses in those years, they can be carried back 5 years with a full regular tax loss carryback. That means that if you had a 2018 loss, you should be able to carry that loss back right now and file amended 2013, maybe 2014 and 15 returns and get a refund right now for losses that you incurred in 2018. The IRS yesterday said, well, yeah, but hold on, we need to figure out how we're going to process these. So before you actually go ahead and file those amended 2013 returns, you might want to wait a week, see if the IRS comes out with specialized guidance for carrying back these losses. And that's probably not a huge issue because it's normally going to take the IRS about 16 weeks or so to process these, because they have to be filed right now on paper returns, and it takes that long to do it. It would be nice if the IRS could say we could e-file these carrybacks, but that would be, I think, unlikely, simply because I don't think the IRS is capable of making the programming modifications that would be required to do that in a hurry. Iowa has not changed their rules, and so Iowa still does not allow carrybacks beyond 2 years. Another key loss limitation for people whose income or loss is reported on their 1040s for their business is a modification of caps enacted 2017, effective in 2018 and 2019 for business losses. Going back and giving you a little background on this, prior to 2018, there were three conditions, three hurdles that individuals that needed to, that recorded losses on, that were reported on their 1040s had to take in order to use those losses. People who claim business losses on 1040s include, of course, Schedule C filers, Schedule F farmers, Schedule E renters, and then people who have partnerships, LLCs, taxes, partnerships, and S corporations. These taxpayers have to clear three hurdles under old law to take their losses. First, they have to have basis to take the losses. That applies to people with partnerships and S corporations. You can only deduct a loss to the extent you have basis in the entity, or maybe in basis in loans to the entity. Then you have to clear a second hurdle. You have to be at risk for those losses. Losses that are a result of non-recourse debt are deferred until you have income or until that debt becomes recourse debt. Then there's a third hurdle, the old passive loss rules. These are rules that were enacted in 1986 to fight tax shelter losses. These losses require taxpayers to be active in a business. What's active in a business? Generally, it's based on an hours test. That means taxpayers who have 500 hours in a business, who have 100 hours in the business and more than anybody else, who have all the activity, all the hours in a business, people who have multiple businesses that they have 100 to 500 hours in that add up to more than 500 hours, or people who have met one of these hours tests in 5 of the last 10 years. There's a special test for retired farmers that allows them to always take losses, assuming that they were active 5 of 8 years before taking Social Security retirement or disability payments. Okay, that's long background to this. For starting in 2018, there is an additional limit on losses, and it was a straight dollar limit. For single filers, you were only allowed to take up to $250,000 of business losses on your return against other income. The rest had to carry forward. For joint filers, that's $500,000. Now for 2018 and 2019, that's retroactively repealed. That means there is no $250,000 and $500,000 cap. That means taxpayers that were affected by those caps in 2018 can now go back and amend their 2018 returns and possibly generate additional net operating losses that they can carry back as far back as 2013 to get refunds. So that's something that you're going to want to talk to your tax preparer about and see if maybe you can free up losses right away for 2018 and 2019. So that's a big opportunity there, and a lot of people will be taking advantage of that. Another big opportunity, another retroactive fix is the so-called qualified improvement property or retail fix. This one again has a history going back to the 2017 Act changes. In 2017, they had changed the tax law to reduce the depreciable lives of a lot of business improvements to real estate. If you made improvements to existing real estate, you would be able to take a 15-year life, and those improvements would also be eligible for bonus depreciation. And when improvements are eligible for bonus depreciation, they can generate net operating losses, which, as we talked about, can generate a carryback. Unfortunately, they screwed up, and while they put this shortened depreciable life in all the committee reports, they didn't get around to putting it in the actual legislation. Well, the CARES Act retroactively fixes that. That means if you have qualified improvement property, you can now take it as bonus depreciation in 2018 if you haven't filed your 2019 returns, and you can claim a net operating loss for that. That might also be available if you have filed your 2019 returns, but you file them under an extension. That's something that you're going to need to talk to your own tax advisor about. But that's an important thing. Another thing that you can do is a lot of taxpayers claimed this qualified improvement thing under Section 179. Section 179 is limited to business losses and therefore can not generate NOLs. So you might want to look at filing an amended 2018 return to elect out of 179 to take it as bonus depreciation and carry that loss back. Another change that affects the 2017 tax law change is to the limits on business interest. This one is not retroactive to 2018, but it is applicable to 2019 and 2020, even if you filed the 2019 returns already. The 2017 laws limited business interest deduction to basically 50% of or 30% of EBITDA, earnings before interest, tax, depreciation, amortization. That has now been increased for 2019 and 2020 to 50%. So if you filed a 2019 S Corp or partnership return where your interest deduction was limited, you can now file an amended return and take a bigger deduction. And just yesterday, the IRS came out with guidance that says you will be able to amend your partnership returns because under prior law, you weren't going to be able to amend those returns and claim a refund. But as of just yesterday, you can amend a partnership return for 2018 and 2019. Finally, we're going to talk briefly about the recovery rebates for individuals. This, of course, is a thing that everybody is talking about because everybody is like, I'm going to get a check for nothing. And the rebate is $2,400 for joint filers and $1,200 for singles. It phases out if your AGI is over certain limits, and it's based on your 2019 return, or if you haven't filed it yet, your 2018 return. You don't have to do anything to claim the rebate. They'll just send it to you. If you didn't file a return for the prior years, and you were getting, say, Social Security benefits, you don't have to file anything. You'll get it automatically based on Social Security records. So key thing to remember there is there's nothing basically you can do. The other key thing to remember about all these provisions, both the SBA loans and the other tax credits and the rebates, is there are a lot of scams out there. IRS isn't going to call you about this. You know, if somebody cold calls you and says, hey, we can help you get your rebate, or hey, we can help you get an advance on your SBA loans, hang up. It's a scam. To get the SBA loans, you have to go through a bank. You got to apply. Nobody's going to apply for you. And for the recovery rebates, it's just going to show up in your account, or if you don't get your refunds through direct debit, it's going to come by check. What's next? Well, there already is talk about a round 4 of coronavirus rebates. That will probably expand the universe of people eligible for the forgivable loans. Hopefully it will answer some of the technical questions that we're dealing with about the SBA loans. Iowa is likely to come out, as I mentioned, with new guidance on how to deal with the SBA loans. Right now, it appears that the SBA loans are, the rebates, the $2,400 and $1,200 rebates may be taxable in Iowa. Iowa's legislature is out of session. They might pass something that says that's not Iowa taxable, depending on how hard up Iowa turns out to be as a result of this recession. There are other issues that relate to, okay, if I take these forgivable SBA loans, will I be able to deduct the expenses that I have? And that's not clear. While the forgiveness will be tax-free, it's entirely possible that the expenses themselves won't be deductible. So you would get tax-free income, but no deduction for the expenses paid with the tax-free loan. That's something that we think might get resolved in the next round of legislation. It's something that you'll want to keep up with. And then to follow these developments, and here I'll give a shameless plug. I'm one of the authors of the EideBailly tax blog. It's under ebtaxblog.com. Every business day we update the latest in the guidance on this, and have lots of links to the guidance and additional information on this stuff. With that, I think I will turn it over and try to answer some questions in the time that we have left.
Absolutely. Thanks, Joe, for that overview. And we'll be sure to include the link to the tax blog in the description of the recording. So once again, we're here with Joe Kristan talking about tax provisions of the CARES Act. So if you do have questions, do feel free to put those into the Q&A box. So you were, I've got a question for you. So you were mentioning, and this is, just it's all about me, for those recovery rebates, Some people may call it a stimulus check, but it's an advance of your tax credits for your 2020 payroll taxes. So help me understand, maybe people at home. So it could be taxable in Iowa as a state income. We don't know yet. And then two, will that have any impact on your 2020 income taxes?
No, unless you, the only way it might have an impact is if you got a rebate and then you're lucky enough to have an income over $200,000 in 2020, but I don't think it's going to affect many people.
Maybe I'll be one of them. So I guess it's only a problem if your income goes way up. Is that what you're saying? Okay.
Yeah.
So thinking about going back and amending and changing returns, whether it be with that net operating loss carryback or some of the other provisions, what kind of urgency would you suggest to people to look at those with?
Well, it depends on whether you're asking the IRS or you're asking my clients. My clients say it's extremely urgent. The IRS yesterday said, hold on, we're not quite ready yet to handle this. Why don't you give us a few days to figure this out? Kind of wish they'd have said it a couple days earlier, because we've already filed for some refund claims on 2018 losses. And those are businesses that badly need it, because if you lost money in 2018, just think, 2020 is probably not a great year either, especially, even by comparison. So, but what I'm going to do for now is, for the ones that I have in my queue, I'm holding off, and I'm going to see if the IRS comes out with something in the next, I'm expecting by this time next week they'll have something. If they don't, I'm probably just going to, start filing again anyway. But one thing you can do is you can certainly start running the numbers and seeing what your and determining what it will be. You can start rerunning your 2018 depreciation for your qualified improvement property and determine what your new 2018 taxable income or loss is without the $250,000 or $500,000 loss limit.
Gotcha. And so with those, you follow those amendments, assuming then that would mean you'd be getting money back potentially. What's the time frame? Any indication from them on how long it'll take for that to actually show up?
That's always the bad part. Excuse me. Unless they come do some reprogramming real quick, all of the 2018 refunds at least will have to be filed on paper, and probably 2019. When you have paper refund, you're talking up to 16 weeks for processing time. And of course, everybody wants it right now, but that's the best that they can do. And when you consider that so many of the IRS people have gone to remote work too, I don't think that's going to improve their productivity either.
Absolutely. So we're just about out of time today. So Joe, thank you again. Any final thoughts as people are approaching all of these new programs, whether it be loans with forgiveness or tax provisions, that you'd like the small business audience to keep in mind?
Well, the main thing is you need to have a little bit of patience. The banks are overwhelmed and don't know what they're doing, because this is just something that was dropped out on them, and their guidance is still incomplete, and they're heavily regulated, so they're scared to death of getting in trouble with their regulators. So you need to be patient and work closely and give them all the stuff they ask. And then you will also need to work with, talk with your tax advisor and make sure that you're making the right choices, that, between the SBA loan versus the employee retention credits. And then finally, one of the big programs is delaying payroll taxes. Remember, those payroll tax payments are delayed, not forgiven. And there's nothing that is harder to get out of than paying payroll taxes. You know, if you're going to defer payroll taxes, make sure you put that money away somewhere safe so that when the time comes to make those payroll taxes, you can pay those. You want to stiff every other creditor in the world before you stiff the IRS on payroll taxes.
Absolutely. Thank you for that. Again, Joe, we really appreciate your time. This morning we were talking with Joe Kristan from EideBailly. We will link out to your tax blog in the description. So this webinar will be recorded and posted for people to view later. You can check out our full series, Coping with COVID-19, Creative Solutions for Your Business, on advanceiowa.com, cbgi.uni.edu, and IA SourceLink. Know that our staff and our services, along with most other professional staff and services, are still up and running and working remotely and here to help you out with your business issues. So don't hesitate to give us a call. You can email us at info@advanceiowa.com or give us a call at 319-273-IOWA. We appreciate your participation this morning. We've got, we're doing these things every day at 10 a.m. So we'll be back again tomorrow and next week. So as we continue to go through, we appreciate you attending. If you have topics you'd like to see, please reach out and let us know. With that, we'll get out of here. Joe, thank you again. We appreciate the time. Stay well. Stay well. Looks like your marsh is doing well over there. So,
well, life in the swamp.
We appreciate it. Take care, everybody, and we'll see you in the next one.
All right.